The dying growth of autumn as America's third industrial revolution, the information age boom. Once again, the nation believed that this time is different because we have technological advancements and investments in the banking sector. The computer industry pushed the United States into the information age with the onset of the semiconductor, which increased productivity of American industry and gave way to new consumer products in a way that have not been seen since the onset of the assembly line. As with the cotton gin and the factory system in the first industrial revolution, or the assembly line and electricity in the second industrial revolution, the computerization of American industry did the job that it would take many people to do over various industries. To help increase productivity and interconnectedness of the global community, consequently, other technologies ran parallel with the increase in the semiconductor technology, and that is the internet that evolved into the World Wide Web. The mass production of the semiconductor and the establishment of the World Wide Web also revolutionized international markets, tying them together by increasing the speed at which data is transferred and analyzed, making markets more interconnected than they ever were before. These new technologies also open up a new consumer market in the technology sector, bringing about new consumer goods from cell phones to flat screens and personal computers, which the production of lowers unemployment through the employing of many personnel to build the way for this new technology. The industrial information age boom promoted full employment to help propel a positive wealth effect along with steadily increasing asset valuations. Combine the increase in technology with the belief in the almighty dollar from the petrodollar and you get a recipe of irrational exuberance. In the belief in the almighty dollar, in 1999, Bill Clinton's administration abandoned aspects of the Glass-Steagall Act that was put in place in 1933 to prevent the type of over-leveraged speculation that helped create the bubbles of the 1920s. On the other side of the exuberance coin, the media helped excite the hype of the never-falling stock market and economy while bombarding the population with goods and advertisements to purchase through various advertisements, which the new televised information age media helped fuel the craze, as how the radio helped fuel the craze in the 1920s and the newspapers in the 1830s. The many new banking investment instruments through various intermediaries of debt, low inflation, trends in national deficit trending towards positive, and a positive wealth effect creating an upward swing in economic activity all gave Wall Street a perception of being an unsinkable ship. The banking industry, through various types of financial options, enabled high leveraging on speculation in any asset class, including the United States housing market. The first noticeable bubble in the third industrial revolution autumn phase was the dot-com bubble. The bursting of this bubble led the policymakers and money changers to disguise it and the effects of the collapse by creating other asset bubbles by various means, which leads us to the winter of the early 21st century. The Great Global Recession of Hyperwinter. The bursting of the dot-com bubble produced the first down wave in market averages that produced a negative wealth effect, which signaled that the beginning of the economic phase of winter has arrived. Many American technology companies found themselves in trouble from the sound companies overproducing while experiencing a drop in demand, which made the technology sector companies lose earnings due to overcrowding demand, to social class inequalities preventing a large market in the population from materializing. Other companies in the technology sector that was making nearly nothing had skyrocketing PE ratios, exuberating asset inflation, which are economic imbalances due to misallocated wealth being shuffled from the hands of the public to the educated investor in the correct position, which help make financial intermediaries and social classes unbalanced. When the technology bubble busted, many companies found themselves in a position to where to compete competitively or to gain a profit, they had to cut production, lay off personnel, and in many cases, close the doors to irrational planning. This process started a spiraling negative wealth effect and waves of mass layoffs. Also, the nation was plagued by an energy crisis that was raising electricity and natural gas rates nationwide, but was centered in California from a supply-side shortage stemming from a cap on rates placed on power plants in 1996. The bursting of the tech bubble started an outflow from American assets, putting the valuations of the global reserve petrodollar into question. Combine the troubles of overproduction and overinflated PE ratios in America's technology industry with an over-leveraged financial sector, a public with a negative savings rate and an energy crisis, and the US dollar on the verge of another long-term downtrend, and you get a recipe for an economic recession that's only comparable to the Great Depression. At the time of the bust of the dot-com bubble, the government was set on not letting the economy fall into recession. Therefore, the White House cut taxes and the Federal Reserve began to lower interest rates to encourage a loose money policy. And also, the nation dropped out of the Kyoto Treaty and capped natural gas prices to relieve the energy crisis. These policy actions set forth a bubble that would shake the globe. The stock market was not showing promising signs, therefore, investors were encouraged to invest into the housing market for lucrative returns. Since the United States Federal Reserve was lowering their interest rates on the global reserve currency, other nations followed suit with the United States and lowered their interest rates and invested their U.S. reserves back into the United States to keep exchange values as stable as possible, but in return subjected those countries to the same impending fate through identical investments. This process produced an upwave in asset markets and economic activity, but like the previous winters before, the first corrective wave did not solve the problem, but only accomplished a corrective wave up and a down wave, and more than likely it made the economy more unstable by confining the United States policymakers within the interest rate debt bubble trap. In the last two economic phases of winter, the American money supply was redeemable in gold. Therefore, as debt and credit contracted, a deflationary spiral set in because market prices had to drop to accommodate the shrinking money supply. This time around, the United States have a global fiat reserve currency backed by the relationship between the Pentagon, banking industry, special interests, and political forces of the branches of the government in a continuing engagement of petrodollar warfare to maintain a currency that the policy makers have been inflating dramatically to hide or to prevent a deflationary spiral with methods that were not possible in the other previous winter phases under the gold standard. When the dot-com bubble busted, the market averages have been crashing steadily when priced in gold. Even when priced in dollars, one can see a market crash with a struggling recovery in the market, even though the market valuations has been inflated by the Federal Reserve through money and debt creation, along with inflating the nation's GDP. By 2007, it was noticed that the increase in housing values and sales could not go on forever because the banks had exhausted all resources in extending the boom all the way down to give the loans to people with no income and credit. The over-leveraging from banks through the housing market was not the only vehicle used to expand credit to the public irrationally. Debt bubbles can be found in the credit card market all the way to student loans. Intertwined within the housing bubble is a web of debt that goes far beyond credit default swaps, which is a derivative bubble hovering around $1 quadrillion, and the global physical problems of sovereign debt that was developed to prevent or hide the deflationary spiral that occurs when the arrival of the social economic winter phase arrives. While the rest of the world was trying to ride out the collapse of the American markets, Europe found themselves in a sovereign debt problem for helping mask the dot-com bubble by helping create the housing bubble through investing into American markets through their sovereign wealth funds. China found themselves in a major real estate bubble with vacant metropolises from hiding their economic woes that came with financing America's housing bubble, bank bailout, and quantitative easing that the Federal Reserve engaged in to hide the economic recession. By choosing to prevent deflation, the United States had fallen into its own physical problem of debt on the public, local, state, national level, and balance of trade during the time of a deflationary spiral that, when you combine the international financial dependence of the petrodollar, the United States and the global economy have to choose between the pot or the frying pan when deciding interest rates level on Fed's funds, which help dictate the direction of U.S. Treasuries all the way down to housing rates. If the Federal Reserve leave interest rates near zero to continue low-cost financing, particularly for the government, misallocations in the economy will occur while paper money look for safe havens brought on by interest rates being lower than the true rate of inflation. Consequently, the problems of imbalances will persist. Maintaining low interest rates to prevent deflation is the type of thinking that got the global economy to this point, and imbalances will continue to all government entities inflate their debt problems away, and with combining the magnitude of the total debt is equivalent to global hyperinflation by definition. If they raise interest rates and other nations follow suit for exchange rate stability with the reserve currency of the United States petrodollar, the governments all the way to mortgage and credit holders will have trouble paying their debts, creating a deflationary spiral in the over-indebtedness economic condition the global economy is intertwined within. Speaking of just the United States government with its bordering $16 trillion national debt, if the nation's policymakers stop expanding the money supply to hide deflation and encourage investors to invest in treasuries by raising interest rates above the true rate of inflation, the government of the United States will not be able to pay the interest on the debt with all its tax revenues, as the deflationary spiral simultaneously deflate tax revenue. And the United States interest payment on the debt is hovering around $500 billion with historic low interest rates, with only a $2.6 trillion in inflated revenue. Pay no attention to the men behind the curtains of many nations as they set forward policies that expand the global money supply, debt levels, and derivative market many times over the productive and asset value of the entire planet to prolong the deflationary spiral of debt and money deflation, and to hide the signs of deflation by creating negative inflation. The only thing that will stop the deflationary spiral that the governments and central banks of the world are hiding through inflation is to continue inflating the excesses away, or to engage in the removal of the excess debt in combination with the new production frontier. The removal of excess debt will cause a deflationary spiral that will bring the financial sector to a halt, as the global financial sector will have to rebuild while massive unemployment will follow. The direction that the policymakers seem to be pursuing is to mask the problem and inflate it away instead. The symptom of using the inflationary method will be the global rise in values of hard goods stemming from the United States petrodollar, creating a form of global hyperinflation till the public demand another monetary system to replace it, or till a type of forceful situation arrive that forces investors or nations not to liquidate any holdings that would lead to inflationary pressures. With using the method of raising interest rates, creating a deflationary spiral, or the continuing of low interest rates, which would lead to the replacement of a global reserve currency or a one global currency, rather if it's US note or not, forced upon the world or not, combined with a new production frontier, would lead the US economy into the first spring of the 21st century.